Good morning and welcome to Market Monday for September 22nd, 2025. As we've all heard by now, the Fed cut rates by 0.25% last week. Here, we're looking at the market, and here's the first time the Fed cut rates in about 3 years, with the market at all-time highs. Except, we're not looking at today's market. This is the mid-90s. Strong market here. Look at 1994. What have we been talking about that's coming next year? Midterm elections. Was 1994 a midterm election year? You betcha. But then all you had to do was tolerate some volatility, some uncertainty, some drawdown, and you would have participated in this screaming bull year right here, 1995. Then the Fed cut the rates. And in fact, the Fed has cut rates within 1% of all-time highs in the stock market 16 times in history. And the S&P 500 was higher a year later every single time, with an average return of nearly 15%, 16 for 16. That's just history. Does that mean it has to happen? Of course not. It really doesn't, but the odds are certainly in favor of a higher market 1 year later. Of course, higher stock markets, high house prices, may be powering the so-called wealth effect. When folks are seeing their assets increase, they feel more confident and are willing to spend more. We do see that playing out here. Over the last 5 years, we see the top 20% of incomes doing a lot of spending, and the very high incomes, the top 3 or 4%, doing most of all the spending. And as a reminder, consumer spending is about 70% of economic growth. So unless these groups slow their spending materially, it would be hard to get a good old-fashioned recession. But it's true, no two recessions or bear markets are the same. That's what makes it so hard to predict. Only in hindsight does that seem obvious. We've talked about all these previous recession indicators, the yield curve inversion, and the leading economic indicators, or LEIs. They've utterly failed this time, whereas before they were spot-on recessionary indicators. So what will it be this time? The federal government stops spending so much money? Private sector has less wealth? Asset prices decline? Reducing spending by the top 20%, which slows the economy, which causes further declines in asset prices in the economy, and so forth? How far would the federal government let it go before it steps in with more funding? This is just one of countless hypotheticals. And who knows? On one hand, we have Goldman Sachs out there with their risk appetite indicator. Here in 2021, peaking way up here, coming back to around neutral as the stock market peaked on January 4th of 22. A couple higher readings over the past few years, but certainly no exuberance where we are right now. And that's Goldman. Barclays, on the other hand, these are two legitimate global investment banks. And Barclays is saying their equity euphoria indicator has only been at these levels during the dot-com bubble, that 2021 frenzy period, and the same one we just looked at by Goldman, this period right here, and essentially now. Euphoria or not, to be determined. And today we'll leave you with this. MoneyGram, the popular money transfer service used for global remittances, is launching its new app with stablecoins under the hood. We've been talking about stablecoins, digital dollars on the blockchain, just about every week for the past year. And this is how we believe they'll go mainstream, under the hood, a seamless experience. After all, if you deposit a check at a bank, do you ever think about how it goes from physical check to appearing as numbers in your account to subtracting from the other person's account? It's a vast and a complex process we don't even think about. And while stablecoins are much simpler, soon enough, we won't think about the plumbing either. Have a great week.